If in fact gold is on top of the game and it's holding it unchanged on the year because of wise, large fund asset managers are saying, listen, we're tired of the paper game. The paper assets are breaking. They're breaking in unison. They're breaking hard, and they're not through. Where do we go? And they perceive gold to be at least a stable place for the moment to be. It perhaps, given more recognition of that fact by more and more asset managers or more and more investors, for example, if gold and silver and miners snap back, if the gold miners and silver snap back, then that flow into that small sector could have an enormous upside impact.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from Momentum Structural Analysis, olivermsa.com. Michael, thank you so much for joining us today.
Be back, Elijah.
It's great to have you. And we're seeing it's the worst 6 months of the year since 1970. So over 50 years, we haven't seen a worse stock market to start the year here. And we're also seeing precious metals fall, but you're seeing an interesting dynamic happening with gold versus pretty much all other markets. Can you expand on that?
Sure. First off, pardon me for touting MSA, Momentum Structural Analysis, but we've had a very good year in terms of calls. In January, we called a major top in the NASDAQ 100, which is the leader index. After all, it definitely swept to the upside. Well, for example, between 2009 and 2021, it went up 16-fold. The S&P went up 7-fold. Okay, NASDAQ peaked by our metrics in January. S&P gave its sell signal in February. Okay, now, since then, we've had a major decline in the stock market. Like you said, the worst in 50 years for the first 2 quarters of a year. During that same time, we also called a drop in muni bonds. Again, these are traditional portfolio compartments, muni bonds and high yield corporate debt. They both collapsed. We're at now levels on the muni bonds and high yield corporate bonds where if you look at a monthly close, the only lows that we've gotten lower are 2009. Okay, so they've been collapsing even more than the stock market. So all your paper assets, the traditional portfolio compartments, have been decimated. There's been no alternative within them to go hide. Even U.S. Treasury bonds, which we now think are in a rally mode, by the way, have been a disastrous place to be this year. So as an asset manager, you're looking around and saying, where can I hide? Where can I at least break even? And there's one major compartment of a traditional portfolio that has effectively been break even this year. It's gold. Right now, we're trading down about 0.5% on the year. And that's in the sell-off. Okay. Now, so when you look at that context of this asset, that, and this, so where do I hide? Where is the safe place to be? Why is it that gold isn't collapsing with the stock market, as it, quote, supposed to do? Remember, that's the popular wisdom. How come it's down in the year only 1 or 2% at its maximum, and it keeps getting corked back up? You know, is it being manipulated? I made a joke today in a report that if somebody is buying gold every time it gets down 1 or 2% on the year, regardless of the broader horizon of these other assets. Why? And I think the reason is that there's some asset managers out there, large ones. So Ray Dalio is an example, and there's others, who doubt the validity of the underlying value of the money unit. They know that the central banks are in an ongoing process of destroying the underlying value of the money units in order to support paper assets. And they finally come to that recognition that that's the real source of inflation. And they want to be in something that will hold its value. And they know that gold is one of those arenas. The problem is, and this has been a bit confusing to us and major confusing to most investors. While gold is held steady, silver has taken out the reaction lows of the last 2 years, which were all around 21.5, 21.5, 21.5, 3 different times between September of 2020 and late 2021. It took it out in May by getting down to the 20 area, and then today got down to under 1950. So on a price chart, you look at silver and say, my goodness, what's going on here? And you contrast it with gold, which is not collapsing. Its lows of the last 2 years were in the 1670s. Right now we're trading above 1810. Why the disparity? And then when you look at the gold and silver miners, whether you're looking at the ETFs like GDX and so forth, they did what silver did, which is to say, if you looked at a price chart after the big surge in summer of 2020, there were repeated reaction lows, for example, on GDX, popular ETF, down in the under 29 bucks, under 29, under 29, under 29. Finally, we blew that out and got down to 27. Right now, we're pushing back up to mid 28s. How come gold miners did that on the downside, took out the lows of the last 2 years, marginally, but took them out? And it had a serious drop since March just to get there. It's painful. And silver did the same. And yet gold's sitting up there in the middle of the range of the last 2 years, picking its teeth. What's going on here? Which is right? Is gold the mama, or is the mama stupid and is going to join the miners in the silver market? Well, it's a big choice, because if the answer is, as we suspect, that the pullback in gold since that March spike high, which was unfortunately largely war-based, but the pullback is held around unchanged on the year. So that's the important point. Is that pullback in gold about over? And we're seeing evidence that if they don't beat the heck out of it this month, especially probably in the next week or two, they're not going to. In which case, you're looking at silver and gold miners as vastly undervalued on a historic basis relative to the price of gold. In which case, they're going to snap back, and the percent snapback just to get back to sort of fair value would be enormous percent gains for them. So that's a situation that in MSA we're focused on and providing our subscribers with specific timing on that issue. But I think right now on a percentage basis, that's the pivotal area to be watching for both rapid turnaround in a given market and to largely the beginning of a sustained return to the upside, which gold never left. Gold never went into the downside. It just went to sleep. So that's a very interesting situation that we think investors should be paying attention to.
So it seems like what you're saying is because of the support we've seen in gold and the strength, that we could start to see a slingshot of the miners, both gold and silver, and for silver itself, back toward the upside, towards fair value?
Yeah, it's not going to continue the way it's been for the last, let's say, since March. All of them made highs in March that look pretty good. Gold pulled back to unchanged on the year, and the rest of them went down and took out the lows, the intraday lows, intra-month lows of the last 2 years. Now, admittedly, those lows are at much higher levels than the price levels of silver and the gold miners back in 2015, 16, and 17. So we're not taking out lows, multi-year lows, we're just taking out the last 2 years' lows. But that's still a significant deviation that is either right or it's wrong. Either gold joins them, lagged to them, or gold is smart and they're dumb and they're subject to investor over bearishness. We're not contrarians at MSA. We study momentum of price, structurally speaking, just like price chartists look at the structure of price. But if we were contrarians, we noted that the commitment of traders report for silver right now is at exceptionally bearish levels, like historically levels that every time you see these type of levels of bearish consensus among commitment of traders, it's a bottom. Okay, so we'll throw that in as a little extra wet noodle evidence. It's not something you can trade off of, but it's something in the background. And so our bias is that, okay, the bears in that sector are on top of the situation and have been for now 4 months. We're now entering the 5th month since the March high. Either they collapse gold in this 5th month of pullback, and so far they've not been able to do that, or the markets that have dropped sharply will snap back. And that percentage snapback alone could be terrific gains. So watch the disparity between gold and silver and the gold silver miners. We think it's a unique situation. And ultimately, if in fact gold is on top of the game and it's holding it unchanged on the year because of wise, large fund asset managers who are saying, listen, we're tired of the paper game. The paper assets are breaking. They're breaking in unison. They're breaking hard, and they're not through. Where do we go? And they perceive gold to be at least a stable place for the moment to be. It perhaps, given more recognition of that fact by more and more asset managers or more and more investors, for example, if gold and silver and miners snap back, if the gold miners and silver snap back, then that flow into that small sector could have an enormous upside impact.
So it's not necessarily just snapping back to fair value, but we could go beyond that?
In other words, it's a game where gold is in charge and it's really poised for the next up leg. And you've got to realize that since I got in the business, which is in 1975, is on the future side with E.F. Hutton as a gold specialist. Gold was legalized for trading in January, and I was hired by Hutton in April. The lowest I've seen gold since I got in the business was at $103.50 in August of 1976. It had pulled back from its bull market peak, had a 50% correction from $200 down near 103. And since then, it's what? It's gone from like $100 to $2,000. Now, why has gold done that? In big legs, admittedly, with sharp pullbacks, but why is it done over that period of time, this consistent upside, massive upside? You go back and look at wheat or corn or the price of anything going back to the mid-70s. They've not done what gold's done. Why? Because the degradation of the money unit has been consistent by central banks of Europe, United States, Japan. It's ongoing and it's not going to quit. There was an interesting little headline I saw. I don't listen to it, but I see the headlines on like CNBC and so forth. The Fed of Atlanta said we're in a recession. They didn't even wait for the data. They know we're there. It's 2 quarters of negative. What if you're in something worse? I suspect we are. I think we've only just begun. And there's a point at which the central banks of Japan, which has never really wavered from its easy policy, to the ECB, which is now starting to waver back toward maybe a little softer approach, and the Fed, which pretends to be, a hawkish. Even the Fed is looking for data points. That if they can find enough of these so-called hard data points, they come, we see them once a month, unemployment or consumer price, whatever, and they see enough things that look okay, you can bet they're going to begin to shift back toward a less, quote, tight policy. And I think if that is the case because of a weakening economy, especially a sharply weakening one, and don't treat the U.S. as separate, by the way. Don't just look at U.S. data. Look at what's happened in Japan and Europe in terms of economic data points. Because as they go, we go, okay? The Fed is aware of that. If they start to see enough excuses to begin to halt their rate rises, which have been trivial anyway when you look historically, and even hint that they're going to cease the rate rises or diminish them, or going to have to increase their balance sheet because the muni bonds are collapsing. Remember, muni bonds are something they bought on their balance sheet back in 2020, 2021, and also high yield corporate debt. Those markets are imploding now that the Fed isn't outright buying them. Well, they can't allow that to happen. Perhaps gold knows that. Perhaps gold knows that the weakening economy of the world will ultimately cause a subtle but serious reversal in Fed policy back to what they do as a business, and that is to support government debt and to support paper assets. And gold is simply waiting for a bit more of that evidence to come into play where people recognize it, say, the Fed quit the game, they're back to, boom. Gold will then, I think, ascend rapidly.
And we have seen, as we mentioned at the top of this interview, the worst start of the year, 2 quarters in the last 50 years. So your take on that, and where is the stock market headed from here?
Much lower. Most bear markets last a year and a half, couple years. Okay. They at least go down 50%. But you got to remember, if you'll stand back and look, we rank this peak in the stock market that ended in 2021, began in 2009, okay, a dozen years, as the biggest bubble in the U.S. stock market history. It beats anything. The 29 peak in terms of multiples off the 1923 low, the 2000 dot-com bubble peak versus the lows that preceded it, the 2007 peak versus the lows in 2003, they were mere doublings or triplings of the stock market. We've had a 7-fold increase in the S&P in a dozen years, a 16-fold increase in NASDAQ 100. And look at an M2 chart and you'll understand why. Or look at a Fed funds rate chart and you'll understand why. Money printed it higher. And if that bubble starts to come undone, and it's the biggest bubble in stock market history, we argue, therefore the unwinding of the bubble could be far more serious than prior bear markets in percentage terms and in perhaps durational terms. Remember, after the 29 peak, you went to a 1932 low. It wasn't until the 1950s that price of the Dow came back to the 1929 highs. So we're not predicting where the low is going to be, except to say it's just begun. We're only 6 months into it. There are going to be fitful rallies, teasing rallies. You're going to see headlines on Fox Business and CNBC about, is this a dip to buy? Is this a tech opportunity? Ignore. We're in a major bear market, a major unwinding of a bubble. The question is, when the river flow comes to protect the bubble, namely central bank infusion of low rates, more money, where will that river flow go? And it does not always go where the Fed wants the river to flow. Quite often, asset managers will make a determination, and investors as well, that nope, I'm tired of this bubble. I'm going to move it into this cheaper asset category. And if you look at a Bloomberg commodity index, just for example, and everybody thinks, oh, commodities are off the page. Bloomberg is not anywhere near back to its 2008, 2011 price highs. So the broad commodity basket, yes, it's had a big move since our bullish call in October 2020. Right now, even in the break that we're getting in the Bloomberg, which is a corrective break, it's 67% higher than it was in late 2020. That's not a big deal. It's not triple or quadruple or quintuple or eightfold where it was in 2020 at its bare lows. So commodity prices as an asset category and stocks related there too, like gold miners, oil stocks, etc., are not overly priced. Yeah, they look overly priced versus a year ago, but versus history, no, they're not. And so asset managers, when that river flows, they take their shovel and they may not put it where the Fed wants it to go. In other words, not put it back into the bubble that's breaking, but put it into asset categories that are performing better. Like gold is unchanged on the year, okay? That sort of smacks you in the face. Whether you like gold or not, and you're an asset manager, you're competing with peers, and you need more position in assets that are stable. So it's basically a group think, that they've got to move to save their firm. So anyway, the Fed will provide that, and I think gold will exploit it.
No, I was actually reading your latest report here, and it was interesting because you did mention the dollar index and how it has been there has been quite a bit of a rally there. I know the dollar index doesn't mean a whole lot anymore because it's just a basket of a few currencies. They're mostly the euro and the yen. But your perspective on where that's heading and how that might impact the other markets?
I think the underpricing of the euro and the yen, based on the relative interest rate levels of them not being as tight as the Fed is, and therefore you get higher interest rate, et cetera, has biased. Of course, the yen has dropped sharply. The euro dropped back to and slightly below the low of 4 or 5 years ago. Not much. Just like the dollar. By the way, everybody thinks it's in some big bull. It's not. Only if you look back a year does it look like it's been in a bull. Actually, in December of 2015, when gold made its low monthly close, I think it was 1,050, 1,060 area, since doubled. The dollar index was 98.67. Right now it's 104 something. Okay, what's that percent gain? 5 or 6%? Okay, 6 years, it's gone up 5 or 6%. And in fact, if you went back 6 months, it would have been break even. Okay, the dollar's really been waffling sideways in a very narrow range, historically speaking, for the dollar. Yes, it's near the upper end of that range, and that influences people when they look at daily charts or weekly charts. But when we do our analysis, we see potential for a V-bottom situation in the euro and the yen. Not claiming they're going to be major bull markets. No, the pricing of those currencies relative to the paper currency we have, paper versus paper, has been overdone. And there's likely to be an ambush rally out of those two pieces of Forex, which constitute over 71% of the dollar index, by the way, as you noted, in which case there could be a surprise sell-off in the dollar index. Now, that's an area that people aren't really focused on right now. There's an overwhelming bullish consensus about the dollar, but it's really not a top issue. Everybody's looking at the stock market and the bond market. But if there were a surprise to come from the Forex markets where you get a sudden jolt and the dollar goes from 104, 105 down to 98 or something, which would be disastrous, by the way, because it wouldn't stop there, and the euro and the yen rally for no explicable reason, simply because they're oversold and overdone, how would gold treat that? Perhaps it would be a little bit of wind at its back as well. And when we look at the technicals of gold and overlay them on a euro and the yen, at least for the last several months, they're a good overlay. Meaning if we do get a flip-flop out of the Forex markets, a quick ambush, we call it, effect, we think it could also ambush the gold bears and plop gold rapidly back up well on the year. So it's a situation we're watching off to the side. It's not been triggered yet. We monitor it weekly and we update the numbers so our subscribers will know when it happens. But it's the kind of event that's off to the side, and this is the best ambushes you can have because not everybody's looking at them.
All right. Well, definitely be interesting to continue to track this, Michael, with you. Before we let you go, if our viewers are interested in learning more and signing up for your newsletter, where can they go? OliverMSA.com, MSA for Momentum Structural Analysis. You request some samples, and we appreciate your interest. Definitely. And if you could maybe summarize for our viewers some of the key things that people should be looking out for in the days and weeks ahead as we see a lot of chaos in the markets in these days.
The macro picture is stocks are in a bear. Okay, ignore the rallies. They're for selling. Ignore the headlines about is this cheap, is that cheap, et cetera. It's when they start to say, oh my gosh, it's all over, then pay attention. Okay, they're not there. It's amazing we've come down this far and yet they're still talking about buying opportunities. Okay, that's the stock market. And that's not just the US, that's Europe and Japan. Okay. The commodity arena, a lot of our opinion is that the oil sector, one area we got bullish on, just above $40 crude and just above $2 natural gas, has exploded dramatically on a percentage basis. We think it's overdone for the time being. That doesn't mean it's a bear. That doesn't mean it's going to collapse. It just means you're likely to enter, and that's a much publicly watched sector of the commodities, of course, as you know, gasoline prices. It's likely to enter a plateau where there's a violent trading range, where both the top pickers and the people who got in late will be whipsawed. It's not an optimal risk-reward place to be. The food commodities are where we're most interested right now because we think that there's a potential that the next leg up in the Bloomberg Commodity Index will likely be led by food prices. And they have not been as excessive. And they've been, in fact, soybeans and corn right now, if you look to your left on a monthly price chart, you can see that last spring and summer, we're trading at the prices we were then. So they've not been overdone. And we think there's a good chance that they could spring load and go for an entire new leg. We're also watching meat prices. These are arenas that aren't, again, they're watching gasoline prices. That's what the president's going to talk about. You know, gasoline dropped 10 cents. Oh, Ray. Okay. Watch the meat prices, soybean and corn. They're very important in the commodity arena. They're probably far less risky places to be than in the energy sector. Again, not that any drop in any of these commodity sectors is a top. It's just a cooling off period, which is technically justified. Copper's another example, for example, that it got up to $5. Huge explosion, doubled in price from 2020 through recent highs. When it dropped below 450, we projected it would drop to about 350. It's now near 350. There's an example of an industrial commodity, which is economically related, naturally. In fact, it's called doctor economy, I think, as some people do. And it makes sense that it had a pullback. It's not a bear, but opportunities there are past. I think the best opportunity out there right now is that situation we defined about gold and the relationship to the silver and the gold and silver miners. They're extremely depressed as a commodity producing arena. And if gold is right and it's not going to break down, then they're wrong and they're going back up. And there's a great low risk, high opportunity arena to be monitoring for breakouts.
All right. Once again, Michael Oliver, thank you so much for your time and God bless.
Thank you, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.